या डिनर
Good morning and warm welcome to you all. I am Vaibhav, your host for today. Our topic for today is FEMA from Auditor's Lens. It shall be taken by Ms. Meera Joycher. She shall covering ensuring compliances and reporting for current and capital account transactions, audit reporting in case of non-compliances, followed by question and answer session. Our agenda for today is virtual inauguration by Dr. Sundar Kataria, invoking the blessing of deity, chanting of Gayatri Mantra, introduction of speaker, presentation by Ms. Meera Joyster, question and answer session, and last closing session. About Sadgun Sangh. Sadgun Sangh conceived and led by Dr. Sundar Kataria, driven with the mission to elevate the quality, safety, and environmental awareness levels of industry. Sadgun Sang is a series of educative, informative events aiming to illuminate professionals on possible solutions to current issues of industry and economy. About Dr. Sundar Kataria, designation and organization, Chairman and Managing Director, International Certification Services Private Limited, academic qualification, doctorate in business management, mechanical engineer. His experience are Rajasthan Atomic Power Project, India's first nuclear power plant at Rawat Bhata, Kota, built by Indian engineers. Worked as nuclear scientist for 11 years and successfully completed and commissioned the plant. EIL, Engineers India Limited, first batch of engineers to develop Bombay High Offshore Oil and Gas Fields, Mega Offshore Complex Platform, Trunk and Submarine Pipelines, Underwater Inspection, Oil and Gas Equipment, etc. DNV, World Largest Classification Society, worked for 17 years at various capacity for the certification of fixed offshore installations, submarine pipelines, onshore projects, and personnel qualification. ICS. He is founder of India's first certification conformance assessment body established in the year 1999, provider of total quality solution. Certification of management system, that is ISO, inspection, testing, and training qualification of personnel. Achievements and awards: receive Lifetime Achievement Award for the contribution for the corrosion technologies from NACE International by NIGIS under NACE USA. Social worker, protection of life, asset, environment, and safety. Now I request Dr. Katre sir to please virtually inaugurate the session.
शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः शत्रुबुद्धिविनाशाय दीपज्योतिर्नमोऽस्तुते दीपज्योतिर्नमोऽस्तुते शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः शुभं कुरु त्वं कल्याणम् आरोग्यं धनसम्पदः.
Please join us for the recitation of the Gayatri Mantra. Introduction of our today's keynote speaker. Designation and organization, senior partner at RC Jain and Associates LLP. Her academic qualification, chartered accountant FCA, followed by DIP in IFRS, Activa UK, bachelor in commerce, certification in an intensive course for service tax, area of specialization and experience, statutory assurance and risk advisory, international taxation and cross-border advisory, structural planning, serving WIRC and ACAI as moderator, speaker, technical reviewer, judge for debates, mentor, etc. for various session courses. Member of core committee of 12 CA Women Entrepreneurs Learn to Lead BCAF Bhanushali Chartered Accountants Forum, invitee member at WYMEC, ICI, etc. Please welcome Neera ma'am. Over to you, ma'am.
Thank you so much for a warm welcome and the kind introduction. Thank you for having me for the session. It's been my pleasure and privilege to be able to share my views and my experience with all you fabulous participants. For the next 1 hour approximately, we'll run this session, and thereafter we can take up question and answers from you. Meanwhile, I'll generally try to continue in English. If you want me to change the language, you can just interrupt and ask me to just continue in any other language. I can just speak a few others, don't worry, but I can continue in Hindi. I'll share my screen first. Just a sec. Okay, the topic for today is FEMA from auditor's lens. But once you run through the session, you will feel that probably from the auditor's lens, if I talk about what an auditor needs to report or something like that, is only covered in my last slide. Why? Because reporting is the last thing that you do. Yes, the most important, but to report something, what you need to know is what is important, what I need to actually do, right? So we will spend most of the time. Why isn't it? 1 minute. Are the slides changing, Vaibhav? Vaibhav, you can just unmute and confirm if my slides are changing. I presume they are. Okay. A first and foremost disclaimer that I'll be covering only common compliances. FEMA is such a wide subject. It is definitely not possible to cover all the compliances, but the major ones which we as auditors come across during our day-to-day examination of books is what I will try to cover in the next 1.5 hours. All the views presented are personal interpretation of the law and should not be considered as a general guidance. Definitely, the decisions and actions will vary depending on the specific facts and circumstances. And before you take an action on any of your specific case, please seek professional advice. We will bifurcate the topic in basically what is to be checked and how to report. What is to be checked can be subdivided into, see, when we are checking the books of account, there are different transactions that are happening and which we need to check from the FEMA aspect. But the transactions can be broken up broadly into capital account transactions and current account transactions. Now, if I talk about capital account transactions, what are those? So if there is an investment in or out of India, I mean, if you have issued certain shares, preference shares, equity shares, debenture. So if any capital is coming in, or we have gone out and invested in any joint venture or any company shares we have purchased, etc. So an investment in or out of the country is a capital account transaction. Anything basically that is affecting my balance sheet directly are capital account transactions. My borrowings and lending, the borrowings in rupees, borrowing in foreign currency, lending in rupees, lending in foreign currency, any type of borrowing or lending happening with or to a non-resident Indian or a person of outside origin, right? So if a transaction is happening, a borrowing or lending with any kind of non-resident, it is attracted under the capital account transaction. Any asset that you purchase from abroad, you're holding a bank account outside India, anything, I'm telling you, anything that affects your balance sheet directly are your capital account transactions. The transactions which hit the PNL and then the reserves are carried to the balance sheet. So any transaction that is hitting your PNL, like maybe the purchase or sale of goods, the services, foreign employees which we employ in India on Indian payroll, whether they are working in India or outside India, Indian employees deployed abroad, franchisee fees, consultancy, technical fees, anything that is affecting my PNL are by and large the current account transactions. Now, why we divide the capital and current account transaction is, if I bundle up the compliances, more or less all capital account transactions can be categorized in one X type of compliances and the current account transactions into a Y category. So that is why it is very important, firstly, for us to identify what type of transaction we have seen and we are actually checking. Regulations for current account transactions. See, current account transactions are your day-to-day activities and they are generally permitted unless specifically prohibited. So if I talk strictly as per the FEMA rule, a current account transaction is generally permitted unless prohibited. A capital account transaction is just the opposite. It is generally prohibited unless it is outrightly permitted. Yes, as on today, the country is pretty open global transactions, and and as a result, the capital account transactions also are by and large permitted. Majority of the transactions are permitted and under the automatic route, but the basic line says capital account transaction is prohibited unless it is specifically permitted. Now, that is why whenever we are checking a current account transaction, the most important is whether it is permitted. These certain transactions, especially when they are happening with my land border countries, right? All the countries with whom we are sharing land borders, those are the countries basically under the caution list, and many transactions with those countries are under a very close observation of the RBI. And hence, in those cases, the permissions required may be a little high. But otherwise, if things, I mean the current account transactions, which I just explained above, if any of those transactions are happening with my foreign countries, by and large, they are permitted. In case of LRS, that is LRS generally applicable when I am conducting a business as a proprietor or an individual. For a resident individual, LRS is applicable, and for LRS, the limits of 250,000 USD per year are there. But otherwise, for current account transactions, there are no other requirements as far as the companies are concerned. Okay, so the permissions, whether they are in place. Secondly, the payments or receipts. Suppose I am importing something from abroad. I need to pay it within X number of time. Generally, it is 6 months, 9 months. During Corona, it was increased to 15 months. There are certain transactions which are otherwise also permitted to be paid or received within 15 months. So every transaction has a timeline. You need to understand which category of transaction it is, what is the timeline attached to it, and the payment to be gone for the imports or receipt of services or for the export of goods and services, the amount that is received should be within timeline. And if it is not within timeline, then we need a specific permission from RBI. You cannot condone the delay by yourself, or you cannot waive it on your own. You need a written permission from RBI. This can be done through the AD category banks. But this permission is required. Please do not just go and extend the credit either in case of imports or exports. Take a written permission. No netting offs or third-party payments are allowed. Suppose I am exporting some goods to XYZ Limited abroad, and I'm also importing certain services from there. I might feel exports are happening, imports are happening, let me net off and only the net amount is paid. Generally, that is not allowed. See, what happens is whenever you are doing, for example, certain export transaction, in case of services, it is not that obvious, but definitely still they have mechanisms, especially now with the GST thing, everything into picture. Initially, what they used to do is they used to capture it through the custom borders. Your goods are going abroad, all the custom clearances have happened, and in the custom, the leg of export has been entered. This leg gets closed only when the money is received in the bank tagging this transaction. So long as this transaction is not tagged, it remains open, and someday or the other, you will receive a query from the RBI. You can receive. And definitely as on today, it is all the more important because the authorities have become stricter in follow-up of all this. That is basically why whenever you are transacting through your bank, initially the sale invoices or the custom bill of export, all those details were not completely provided to the bank. You gave certain transactions, some bills, certain documents, certain you did not give, and banks also did not bother. If those documents are not provided, suppose you receive money, but your export of goods are not on record, what will happen? One leg is in their system, the second one is not, and the mismatch can trigger a query, right? So ensure that both the legs, both in case of export as well as imports, is definitely taken care of. All documents are there in place. Do not net off. If you need to approach the RBI, take a permission. Only after that netting off will be allowed. And in the current account transaction, especially in cases where you are sending money out, the TDS compliances play a very important role, because if you have paid any money without deduction of taxes, the department will claim it from you. The tax audit disallowances will happen, and there are so many consequences. Each of y'all are aware, right? So do not miss on the tax deductions. Deductions can be as per IT as well as DTAA. Most of the cases, what we feel is we directly pick up the DTAA, what is mentioned over there, and we just deduct. It is not so. Whenever you are evaluating, you need to first establish whether as per Income Tax Act, was there a deduction applicable. If it was applicable, the second step is to check the DTAA. Why? Because if as per Income Tax itself, the deduction was not required, then the rule which says TDS is as beneficial to the recipient means if as per income tax, he is in a beneficial position by not getting the taxes deducted. Even if DTAA says taxes to be deducted, you don't have to deduct taxes. Taxes, especially in case of procurement of goods, definitely is not required, because there is no TDS applicable as per Income Tax Act itself, right? So we always have in mind, any foreign payment, deduct taxes. No, especially in import of goods, no taxes. Import of assets, it is again goods for them, the person who is selling, right? No taxes are required to be deducted. Banks will still tell you, give me a 15 CACB. And we as chartered accountants are forced to give this certificate. However, as per pure law, FEMA, it is not required because taxes are not applicable. See, if tax is applicable and it is zero, a 15 CACB is required. But if tax payment is TDS is not applicable at all, 15 CACB is not required at the first place. So first, submission to the bank should be, it is not required. If they force and they are just not proceeding with the payments, you will have to give it, and then you have no choice. Right? And yes, for the current account transactions, by and large, if this much checking is done, you are in a comfortable position. Tension starts in case of capital account transactions, because there a lot of reporting and regulations are tracked, right? So not spending too much time on the current account transactions, we'll shift to capital account. If you have any queries, please jot it down. We'll take it up together at the end, unless you feel it is required to be done now. Capital account transactions. As I told you, if there is a foreigner, a foreign resident, which can be an NRI or an NR, that is person of other origin, but wants to invest into India, or an NRI, if he is investing in our company, which is called FDI, foreign direct investment, there are a lot of limitations with regards to what is the type of company or the organization. For example, if he wants to invest in a proprietary concern, he wants to start his own proprietary concern, he cannot start. partnership, he cannot invest into the capital of partnership. He may, if he wants to do it on a non-repatriable basis. What do you mean by non-repatriable? A non-repatriable generally means that the investment that is brought into India will remain into India lifelong. You keep on reinvesting, earn more profits, do anything with that money in India. You don't take it back. So that is called as non-repatriable. So long as a NR wants to invest into India on a non-repatriable basis, he can please go ahead and do even in a proprietary or a partnership, but otherwise he is not allowed. And this all I am talking under the automatic route. Under an approval route, everything is possible. If the RBI is convinced that the NR who is investing is a genuine person, with that India is going to benefit, they can definitely give permission and you can go ahead. But under an automatic route, you will not be allowed. And whenever such FDI is happening, and as I told you, in a partnership or proprietary, it is not allowed, but LLP, company, private limited, public limited, all those type of companies, and FDI is allowed. So whenever such FDI is happening, that is either they are subscribing to my memorandum or they are purchasing the shares from an existing shareholder, I am issuing them further shares from the company, all that is called an FDI. And whenever such FDI happens, the company who has issued shares or whose shares have been acquired by such foreigner, FDI in case of an unlisted company is starting from rupee 1, which means even 1 rupee invested by a non-resident in the terms of in form of shares, preference, compulsory convertible debentures, whatever, is an FDI. In case of listed companies, this FDI thing gets attracted only if a total non-resident investment in the company is more than 10% of the total capital, right? So if you fall under the FDI category, that is the company has received an FDI, it is required to create this entry master form on the firm's portal. This is basically giving all information about the company, what kind of shares, to whom it is allotted, KYC, everything will be in place for the regulators to inspect, if required, what is the status of the company. Okay, so there is as such no timeline when entry master form should be created, but this is the first step. Without the EMF, you will not be able to do any further compliances, right? So the first step when any share or anything is issued to a person resident outside India, that is a PROI, what the company needs to file is an FCGPR. This form is required to be filed within 30 days of the issue of equity shares, and it can be filed only if the entry master form is filed. The FCTRS is a form wherein the existing resident shareholder is either selling shares to a foreigner or a foreigner is purchasing it from the resident. If the resident person is involved in the purchase or sale from a non-resident, then the FCTRS is applicable. Foreigner selling to foreigner or resident selling to resident, FCTRS is not applicable. Timelines are given. This chart you can refer to later on only, also because I'm just giving you a glimpse. This is the first transaction. Then on an annual basis, by the 15th of July every year, for the year that has been completed on 31st March, on a form FLA, that is Foreign Liabilities and Asset Form, is required to be filed. You are required also to file form APR, that is Annual Performance Report. The company wherein the form APR is applicable in case of an ODI, right? Sorry, I have written FDI also, but it is generally APR is required in case of ODI, wherein I have invested in a company outside India, and that money is not just gone out as a hawala. We are genuine in investing that company. That company is a running company. It is reaping profits. It is running in a good, healthy manner, is what they monitor from this report, and APR is a physical form that goes to your AD bank. Form ESOP is to be filed when you are issuing any shares by the form of ESOP to a person resident outside India. These forms till now were to be filed in case of companies, private limited, public limited, whatever. And if it is an LLP, then form LLP 1 is the form which is filed similar to a KMP, that is key master form. The entry master form which we talked about, the LLP1 is a similar form. It just gives a basic information of the LLP who has received the capital contribution. Form LLP2 is wherein the capital contribution is being transferred between the shareholders, or a new capital contribution is received by the company. Form depository receipt return, DRR, is whenever you, a depository custodian, it is to be filed by the depository custodian whenever a depository receipt has been issued. An investment vehicle issuing the units to a PRI, form NV. From CN is where convertible notes have been issued. Form DI is wherein a company which has received share holding from abroad, that is, there is an FDI, and such a company is further investing into another company, which means I will call it as a step-down subsidiary. Step-down subsidiary of a company which is held by a foreigner. If such a company is making the investment, this is called a downstream investment, and for that also form DI is compulsorily required to file. Form ECB is wherein you are doing any kind of borrowings. See, when a individual is doing a borrowing, they are allowed to borrow only and only from their relatives, from their NRI relatives, not from anyone else. But when it comes to companies or LLPs, they are allowed to borrow, but they have to follow all ECB guidelines. ECB guidelines start with creating a UIN, then you have to creating a loan registration number, because when you are accepting a loan, you have to create a loan registration number. Only after that the money can be received, and there are several guidelines as to where this borrowing can be procured, from where it can be procured, how it is to be procured, the maturity, minimum maturity period, the rate of interest that can be given for the borrowings. The end use of the borrowing is very much important. You cannot say, for example, you are borrowing for purchase of fixed assets and then you utilize the same in working capital, will strictly not be allowed. It is not allowed in India also. But here you need to be all the more cautious about it. Form ECB2 is a regular monthly return whenever you have an ECB, that is a borrowing. ECB1 was the first form, and ECB2 is a monthly form giving regular updates on whether there were any further borrowings, interest, everything about it. Form FC, initially this was like the form ODI, is wherein I do an overseas investment, that is an Indian entity investing in any kind of entity abroad. Suppose I am purchasing some shares for a Dubai company. I am setting up a company in US. I am setting up a company in UK. All those are ODI, that is overseas direct investments, wherein form FC is required to be filed. Here, what is important is the financial commitment. Financial commitment includes every kind of spending, let it be the shares that I'm actually purchasing, any kind of further loan that I am giving to that kind of company which is associated to me now, the disinvestment, restructuring of those companies, step down of those companies, everything is covered over here. And the total this also includes a guarantee. If I, as the shareholder of a foreign entity, I'm giving a guarantee to that company or its associate or step down subsidiary, is also to be a part of the financial commitment. The entire financial commitment needs to be added together and should not be more than 400% of its net worth. A company having a net worth of, say, 500 rupees, it can invest outside India only for 2,000 rupees. I keep generally whenever I'm presenting, I keep numbers very small rather than taking it into billions and trillions, because these numbers are easier for us to understand. So as I told you, if my net worth means total assets minus total liabilities, and the net worth can be also taken out in terms of any other valuation methodology, but generally accepted is my book value method. If my net worth is 100, I can invest 400. If my net worth is 500, I can invest 2,000. Okay, which includes my share purchase, which includes my loan guarantee, everything. Now, here for the different forms that we were required to be filed, when I talk about, I'll come to, suppose we are analyzing a balance sheet. What are the transactions which will form an FDI, which will form an ODI or whatever? Don't get confused over here. Here, I will take it a little quickly. We will run to the slides wherein I will tell you in case of an FDI, what are the compliances? In case of an ECB, what are the compliances and things like that, right? So, suppose you find a share capital being issued to any kind of foreign resident, it comes under the category of FDI. The reserves and surplus are attached to it. You can also attach ODI guidelines to this, because as I told you, my ODI has to be within 400% of my net worth. So my share capital plus reserves total should be 1/4 of my total ODI. Money received against share warrants. Suppose I have received certain amount which is lying in my balance sheet as share application, but I have not allotted shares for it. It will not be called as FDI till the shares are issued. Now here I would say shares are issued means I receive money say in September 2024. Until March 25, I am not issuing shares. And I say there is no FDI. You can't keep, as per company law, you cannot keep the money. You need to allot the shares within 60 days, right? So the company law guidelines are going to run simultaneously. But yes, if I talk about the funds having been received on 1st March or say 15th March, I am yet to allocate the shares to them. Then on 31st March, this will not be called as FDI, and the regulation and compliances related to FDI will not be applicable. Okay. Share application money, these are all FDI. Now, if I come to non-current liabilities, long-term borrowings, other long-term liabilities, these are all my ECB, that can be external commercial borrowings. Now, external commercial, the other long-term liabilities may also include certain trade credits. Suppose I have given certain, exported certain goods or services on credit, and my creditors form a part of this long-term liabilities, then it is a current account transaction. So all transactions relating to my current account, which is my trade credit, needs to be checked over here. All import related regulations, definitely, whether the bank has been informed, my custom clearance has happened, I have necessary IEC code, everything, all those will definitely be there. But those are as per my Indian laws, and that is why I am not touching, too much over there. I am touching more about the FEMA aspect. My short-term borrowings again can be either ECB or my trade creditor. The manner of payment regulations, as I told you, it needs to be received within X period of time, 6 months, 9, 15, depending on the category where it falls. My trade payables and other current liabilities. So these are the different types of transactions which I need to observe. If I'm observing a financial statement and I see any foreign currency being triggered in any of these categories, then the FEMA checking and the FEMA compliances definitely need to be checked. So as an auditor, we generally feel, अरे हमारे पास तो FEMA का काम ही नहीं है, हम तो बहुत छोटे chartered accountant हैं, बहुत छोटी companies हैं, we don't have any FEMA exposure. Today, I don't think there will be even a single chartered accountant who will not have any kind of exposure related to FEMA. Few will have related to individuals, many will still have it related to the companies also, because even if you're not receiving capital, definitely you are doing transaction in terms of exports, imports. So anywhere a foreign currency is touched, FEMA compliances get triggered. Simple basic rule. And as I told you, I cannot, if for example, if I take up only FDI, I can speak about all the regulation compliances, etc. about FDI for the next 3 hours. We will not be able to cover it in 1.5 hours. So all will not go to that depth, but take it from me as a thumb rule. Check every line item. Wherever you feel there is any single slightest FEMA aspect, please read about what are the compliances. See, for example, if I talk about borrowings, in case of ECB, we several times find that the foreign entities have parked their money over here. We have taken it from NRIs, from anyone, and it is lying in my borrowings. But we have not followed the ECB guidelines. Definitely, this is going to attract trouble for you. Right? You need to know ECB is very much important if even a single rupee of borrowing has been done from a non-resident by an Indian company. On the asset side, if I talk about, suppose a property, plant and equipment has been purchased and the assets have been purchased from abroad. So these assets, firstly, the import-export related transaction, all those guidelines and regulations definitely need to be followed. But if you find ECB has been done to purchase the assets, then as I told you, the end use, whether the end use is correctly happened, yes, the assets have been purchased, whatever money was received has been properly parked into these assets. So long as all that is in place, you are happy. It can be tangible assets, it can be IPs. IP purchase also is very, very common nowadays. Non-current investments. Non-current investments are my ODI. As I told you, I am sending money from here abroad. If I know that money, so non-current can include your loan. If I know this loan is going to come back in 6 months, this will be more than 6 months. So any kind of shares that you have purchased or any loan that you have given on a long-term basis, all that will be a part of your non-current investments and attracting ODI compliances. My long-term loans and advances. In short-term loans and advances, again, it will be in the category of ODI. Trade receivables, I told you all export regulation, manner of receipt of the payment needs and cash equivalent can include a bank account that is outside India. As an exporter, you are allowed to keep a bank account outside India. So if such a thing is there, cash and cash equivalents will have this under that category, and you need to check if all foreign account regulations have been properly complied with in case of such a bank account. Contingent liability. You've given any kind of guarantee. I told you financial commitment. So a financial commitment given to your subsidiary, joint venture or any kind of entity outside India or their step down subsidiary. It is your capital commitment, financial commitment, and ODI regulations need to be complied with. Coming to my P&L, in my revenue from operations, if I'm exporting goods or services, so all regulations relating to export to payment receipt within the timeline, paperwork, documentation with the bank relating to the export invoices as well as the import money that you have received. Don't try to take the money through credit cards. See, what happens is it does not get tagged to your export. This applies also in case of imports. They do not get tagged to your export or import that has been done through the custom barriers, and the leg remains open. What happens is money is received, you are happy because your balance sheet is not showing any debtor or credit. You just move ahead with life. But later on, if this transaction is open, you are always subject to queries, and hence try to get the money through normal banking channels. Don't do it through your credit cards. This applies also in case of foreign direct investment. Here, when I'm talking about the share capital, see, if you are investing certain money in US, right, or maybe in Dubai or Singapore, the capital contribution is very, very minimal. You can open a company with just $1. And in case of US, you can open it with $0. You can subscribe. They'll never ask you to actually pay the money. You don't pay the subscription money for 2 years, 5 years, 15 years. They'll not come and tell you, give me the capital contribution in the bank account. They are only bothered with the companies running in a healthy manner and it is creating revenue for the government. They are happy, right? But as far as India is concerned, it is an FDI. And in such cases, generally what happens is the client does not inform you, and as a result, you are not able to check anything. So, from auditor's point of view, if there is no evident, I mean, there is no evidence which can trigger your attention, they cannot come hammering on claiming negligence. But ask the client specifically if any, see, for example, you find certain dividends coming in. So if no investment has happened, how can dividends come in? Or if certain transactions are happening, some money in and out is happening, you find your clients frequently going abroad for businesses. Ask specific questions. Have you opened any company out there? Sometimes you find similar name of companies with whom the Indian company is transacting. So ask specific question whether any shareholding or any kind of direct investment they have, I mean overseas direct investment they have done outside India. What happens, as I told you, they'll just take out $1 from their pocket, give it to the consultant out there, and they'll say just open the company. In case of overseas direct investment, whenever such ODI is happening, first and foremost thing you need to do is receive a UIN, that is unique identification number. Who will give you that? The AD bank. I mean, all this compliance happen for the RBI, but it is through the AD bank. So as I had told you, there is this form FC when an individual is doing, or the form FCGPR, which I am talking about. In all such cases, I mean, FCGPR is wherein inward investment is coming, and form FC is when there is an outward investment. So this form FC is required to be filed within the 30 days of making the investment, and which includes that 1 rupee of share that you have purchased. One of the requirement is this form is required to be filed, based on which you will receive a UIN. The money for the share capital or the direct investment needs to go from India, right? So that 1 rupee taken from your pocket, paid to the consultant, share capital ho gaya. What happens is you have not filed form FC, UIN is not there, money has not gone from Indian account, so it becomes very difficult to bring into the system. So please ensure, alert your client that even if they have done this transaction with that 1 rupee of cash, ask them to return that 1 rupee cash by the company outside India, fill this form, get a UIN, and transfer this $1 again from India through the banking channels. Right? So as I told you, the export-import related or your FDI or ODI related, no transaction is to be done through cash or through credit cards, because that will be easy, but that will not bring the transaction into the RBI system and can create problems for you in the future. The finance cost. Finance cost, I need to check the ECB guidelines. That is, when the money is received, what were the payment terms, what were the interest terms. The interest is generally not allowed over beyond X percentage over and above the bank minimum rate. So that X percentage plus the bank minimum, what is the the ECB interest rate, has to be maximum charged over here. You do not have a free hand on giving them any amount of interest, right? And the exceptional and extraordinary item, this just might draw your attention to if there is anything related to ODI. Suppose I've received a dividend. For example, see here in other income. In other income, you might have received a dividend. Suppose you have done a loan, you might have received interest on that. Definitely that is not a part of your revenue from operations. But if you find any kind of such transaction in your other income, check what it is, and that will also might lead you to the ODI or FDI kind of thing, right? So these are certain heads which should create an alert in your brain stating here is where a FEMA can be triggered. This is simple. Whenever whatever audit procedure you are following, definitely you are going to run through the balance sheet. And when you're running through the balance sheet, the trial balance, the ledgers, if a foreign currency has been received or paid, it will come to your notice. You just have to identify what is that, which category it will fall into, and check for the compliance of that category. Say, as I told you, suppose it is an FDI, that is a foreign direct investment, which means a foreigner directly investing in India. Directly investing means subscribing to my capital or giving me loan directly, not through an investment vehicle or not through the stock market. Right? So that is a foreign direct investment. What are the compliances? If you find from your transaction or review of the balance sheet that there is an FDI that is getting triggered, check whether the KMF is filled and the master is created. Form FCGPR wherein directly shares are allotted. Form FCTRS. As I told you, shareholder to shareholder transfer. FCTRS is required to be filed by that Indian shareholder. Let it be the recipient, I mean the seller or the buyer. That is not important. But if any one side of the transactees is an Indian resident, FCTRS is to be filed by that person. If the company is buying back the shares, then I am the buyer who is an Indian resident. So the company will be required to file FCTRS. But as I told you, if it is happening between the shareholder to shareholder, if I take a plain view, FCTRS, they have to file, company need not be bothered about it. But if I need to register that change, X Limited abroad in Dubai has sold the shares to an Indian resident, or an Indian resident has sold it to Y Limited from US, my shareholding changes and that shareholding needs to be in my records. So long as FCTRS is not filed, my entry master, that is my KMF, will not reflect this change. So even if I change it in my balance sheet and if there is a mismatch with the master, it is going to trouble me only later. So indirectly, the company should ensure that FCTRS is filed and better take a copy of it and put it in the records whenever the shareholder is approaching you for registering them as your shareholder in your records, right? Officially, you are not required to keep track, but unofficially, yes, I will advise you should take a copy of it. In case of a employee share allocation, form ESOP, LLP 1 and 2 or INVI, DI, these are the forms wherein the share allocation transfers are taking place. Suppose in your balance sheet, I'll just I mean, these are the case studies we are coming to later on. See, this is one case study where I'm talking about note about the share capital, wherein you find ABC Inc. was a US company holding now as 100% shares. But if I talk about the previous years, they were holding only 90% and 10% was with some Mr. India, who was an Indian resident. Current year, you find that Mr. India is no longer having any shares. The entire 100% is now held by a US company. Yes. So initially, when the 90% was issued to them, at that time, KMP master has been created. For FCGPR was filed, which will allow this 90% to be brought into the master. Thereafter, when this 10% was shifted from Mr. India to the foreign entity, then FCTRS was filed. I preferably take it on record. In between, if I had issued that. So long as these forms are not filed, no, my entry master will not reflect all the foreign shareholding, the change in that. And hence, these files are very important. If not filed, there are consequences in terms of penalties and prosecutions also. So for those reasons also, it is important that these forms are filed. Whether the FDI is in automatic route or approval route. As I told you, as of today, except for say agriculture, real estate, financial sector, these 3-4 sectors, Nidhi or chit funds, things like that. Except for those sectors, most of the other sectors are under the automatic route. And when I tell it is under automatic route, which means I can just directly come, I mean a foreigner can come, subscribe to the shares, we issue the shares. But there are certain companies or certain sectors, for example, the insurance sector, the defense sector, in those 100% is not allowed. Somewhere 90% is allowed, somewhere 50 is allowed, 20 is allowed, all depending on that. And there are several sectoral caps in terms of the percentage. There are related other compliances. So the company wherein this money is received needs to be checked for which sector it is into. When this money is received, whether it was under automatic route or it was under approval route, were there any attached conditions? If there were attached conditions, whether the company is following those conditions. All those adherences are very much required to be filed. And yearly once, form FLA, which I told you 15th of July every year, this form FLA is required to be filed. It is again an online form to be filed. These are the major compliances if you see any kind of FDI having received in that company. Got it? Second, when I come to form to an ECB, that is any kind of borrowing that I have done, I need to compulsorily file form ECB, which is again an online form on the firm's portal. And this form, once you file this form, you will receive an LRN, that is a loan registration number from the RBI. Only after the loan registration number is received, you should actually draw any kind of money from there. It should not happen that the money has already come into the bank account and then you do not even have an LRN. What happens is every time then you want to make a payment of interest, you want to return the loan. Money coming in will be very easy. No, as of today, theek hai, there are many banks who are restricting even the inward of money, but that restriction generally happens if money is received from, say, Dubai or any kind of Middle East companies or companies like Pakistan, Bangladesh, Sri Lanka. But if you talk about money coming from US or a UK or Australia, the banks will generally not obstruct on receiving the money. They'll take the money. But if you do not have an LRN, if you want to repay this money or you want to pay any interest on this loan, you will not be able to pay. Because when it goes from India to abroad, the banks are very strict. They'll, even when it is going to US or a UK or an Australia, they'll definitely ensure that if there is no LRN, they will not transfer the money. So ensure the first step is correct. So from auditor's point of view, whenever you find a borrowing from a foreign entity, check for the ECB guidelines. As I told you, ECB, from whom it is allowed. You cannot borrow from any Tom, Dick, Harry. You can borrow from a foreign shareholder. You can borrow from a foreign bank. There is a list of eligible lenders in case of ECBs. You can borrow only from them. Even when you're borrowing from them, there are regulations with regards to the end use for what you are borrowing, whether the use exactly happened for that reason or you actually diverted the funds. So all those borrowing terms need to be adhered to. LRN needs to be in place. The end use regulations need to be strictly followed. If the return has to happen, there are those guidelines with the minimum maturity period, maximum maturity period, interest rates, whether each of such regulation is strictly followed. The monthly returns which are required, as I told you, that ECB2 is a monthly return that is required to be filed before 7th of the next month. Whether that is regularly filed, even if you have not drawn any money or you've not paid any kind of interest, still form ECB2 has to be filed as nil. Then appropriate charge has been created. Suppose to borrow the ECB, you have given any of your assets as collateral or a direct security. The charge in ROC and everything needs to be created. So ensure that is in place. ODI, Overseas Direct Investment. A company in India, that is an LLP in India, an individual in India, partnership in India, is investing in an entity outside India. That is overseas direct investment. Again, as I told you, if I purchase these shares from their stock market, it is not an ODI. So it is a direct investment. Whenever I'm making such direct investment, Form FC is required to be filed. जैसे ECB 1 file किया, you received a LRN. Similarly, when you file Form FC, you will receive a UIN. Only once UIN has been received, you actually make the money transfer. The share capital that you are transferring or a loan that you are transferring needs to go through the AD category banker, having tagged it to the UIN. Don't pay it through overseas bank accounts. Don't pay it through your credit card. Don't pay it in cash, please. And here, when I tell you, when your client has made all these payments from any of these any of these channels wherein your transaction could not hit in your bank account and you did not come to know. As I told, just try. If there is any slightest hint to give you such transaction exists, keep on pestering them with such questions and take it in writing from them that they have not made any kind of foreign investment. Because what will happen if later on it is proved that you had a reason to believe that such a transaction was existent and it was not captured in the financials and the auditor's report, you can be charged for negligence. Then amount, also termed as financial commitment, includes the actual amount that is transferred in for the share capital or the loan, etc. Any kind of equity loan, any kind of guarantee given, everything is a part of this, and it should not be more than 400% of the company's net worth. The share certificate received by the company, you need to ensure that the foreign company actually gives you the share warrants, and those are received in India. A copy of that is given to the bank within 60 days. Form FLA. I already told you there, even in case of an FDI, Form FLA, that is foreign liabilities and assets. When an FDI happened, there were foreign liabilities. When assets, that is an ODI takes place, an asset is created. So Form FLA is required to be filed. And also Form APR is required to be filed. What is APR? I told you it's an annual performance report. Whenever I'm making such overseas investments, just a sec. Okay. Whenever I'm making such overseas investment, the performance of that associate or the performance of that subsidiary is monitored by the regulators, and to do so, the annual performance report is required. This will be based on the audited financials of the foreign entity. If that country does not require auditing, then the auditor of the Indian company or the Indian entity will do an audit of that company, and they'll give this APR, which is to be certified by the Indian statutory auditor, right? So APR is applicable only in case of an ODI. FLA is applicable for an ODI and FDI both. FLA is required to be done only for other than individual and HUF. The logic behind that is your foreign liabilities and assets do get captured in your individual ITR. You have Schedule FA, if each of you all remember. The Schedule FA captures everything related to your foreign liabilities and assets, and hence FLA is not required to be filed by an individual HUF, but all other entities are required to. APR is required to be filed by all entities making an ODI, including an individual and an HUF. The returns on investments, that is, suppose I have a share subscription, then if I'm getting dividend, if I have a loan, if I'm getting any interest, I cannot park those funds outside India. That money needs to come to India. So if you feel any investment returns parked in your P&L account and you find that the money has not been received within the timeline, then you need to report on it. That is something that is creating an alert. If I am doing a disinvestment, then that is that you have a sale proceeds for those investments, or a loan is getting returned. So all such disinvestments are also required to be remitted back to India. You cannot keep this money in an outside bank account without the permission of RBI. If RBI gives you written permission, it's absolutely fine. Now, I actually shared what is to be checked in what categories. We'll just take few examples to give you a hands-on on how I am checking, right? See these highlighted blue items. Say other income might include your dividend, your interest on ODIs, etc. Administrative and other costs, right? If any kind of, sorry, let us start with the balance sheet. There is this shareholder share capital for which my FDI is getting attracted. Long-term borrowings, other current liabilities, which includes my FDI as well as any kind of ECB, my long-term loans and advances, other non-current assets. So all these blue highlighted are items wherein there might be something or the other related to FEMA. So I will target the notes for them. The administrative other costs are my current account transactions. Other income can be my current or capital account transaction, right? And these are my related notes for that. I have sub-broken it, so I'm running fast through these slides. So say this is my first note. We had glanced this note earlier, wherein ABC Inc. USA initially had 90% holding, 10% was by Indian resident, and which is now converted. It has been transferred from Mr. A to the US company. So whether the FDI has been first received under the automatic route or approval route. Then shares have been allotted to them within the prescribed timeline, whether the reporting in form ARF, which was initial form, whether the private limited company is operating in a sector wherein the FDI linked performance conditions are present, and if present, whether they are complied with the sourcing norms. See, there are certain companies wherein the compliance performance condition includes something related to you need to buy, say, 30% from an MSME. If that performance condition is attached to my FDI, then during the year, I have to ensure that whatever procurements have happened, at least 30% have happened through the MSMEs. So this is one example of a performance linked condition. Any such condition I need to check for. Whether FCTRS has been filed by Mr. India when he is selling his shares to the USA company within 60 days. Whether the private limited has taken record of this FCTRS, which I told you, it is generally not compulsory, but yes, when I need to take these shares on record and this transfer on record, I will prefer it is always taken. Whether the entry master form has been first filled. Suppose it was an old FDI, that is before 2018. The entry master form EMF is introduced from 2018. So if it was a prior company, prior investment, then all such prior FDIs were required to file this form in 2018 such that this master gets created, and any changes via the FCTRS, GPR, ESOP, whatever those forms are, all those changes will then automatically get reflected in my entry master. I don't need to go and change it every time. Then whether form FLA has been filed, form FLA filed based on provisional accounts. The form FLA which I'm talking, it is to be filed on 15 July. You might just state that by 15 July, the financials of those companies were not ready. So in such a situation, you can file a provisional account and thereafter revise it. If there subsists any contravention in FEMA, whether compounding, etc., was done, and all regularizations based on the FEMA regulations have been in place. So this is my next note talking about the reserves. So these are my opening balance during addition. This is closing. So my reserves plus my opening balance total is my net worth. In case of an ODI, whether the total financial commitment is within that 400% or 4 times of the net worth. with the correct figure of reserves and surplus. In Form APR as well as FLA, you need to disclose the reserves figure. So this figure is correctly reflected in those forms, right? In note 3, you found ECB from Bank of America. So whether the ECB form has been filed, LRN obtained, the drawing down was done, this 2 lakh rupees was received only after LRN, then this 2 lakh rupees is at all in all and minimum average maturity period, all in all ceiling costs, end uses. These are several terms and conditions attached with ECB, whether they have been complied with. Monthly return in ECB2 has been filed. Even if it was nil, that is no drawal, no interest, then even if that in such cases a nil return was filed. The fourth is wherein you have done an import from a foreign entity and the sundry creditors are standing. As I told you, whether the outstanding is for more than 6 months, it was there during COVID times, it was extended to 12 months. But if within 6 months the money is not received and this outstanding is for more than 6 months, then whether the extension from the RBI through the AD category bank was obtained, all import dues were for more than 3 years. See, whenever a 3-year period has crossed, even if you have taken permission from the RBI, even such cases, you will be put under a caution list. The company will be put under a caution list and the recovery of export incentives, etc., which was earlier given to them, will now be reversed. So all those reversals, etc., have been done. And whenever this money, suppose after 3.5 years, they receive the money, I need to approach the RBI, get the name of the company removed from the caution list, and now I can claim my export incentives back, so long as the system allows me. The fixed assets, suppose I've purchased these machineries from ECB, then whether the end use proceeds, etc., are met with, the assets are correctly reflecting in FA, the charge has been created under ECB as well as under my company law. In case of a long-term advance, a loan granted to XYZ DMCC, which is DMCC, I'm talking about Dubai company, right? So whether Form FC, this is an ODI. So whether Form FC was filed, whether it is within 400% of my net worth, the loan has been granted only after making investment into the capital of XYZ DMCC. If I am not the shareholder of the company, I cannot give loan. I can give loan only to my joint venture or my subsidiary. So if I am holding their shares, only then I've given the loan. If I am not, then it is not allowed under FEMA and it should not be in place. Whether Form APR has been filed before 31st December, whether repayment of the loan has been reported in Form APR, all this needs to be in place. Non-current assets may you found unquoted shares of XYZ DMCC, which is a wholly owned subsidiary, and unquoted shares of FEM, which is a joint venture. Then here it is an ODI, so Form FC required to be filed. Share certificate has been received and it is sent to the AD bank within 6 months. Form APR has been filed every year before 31st December. And whether dues receivable in respect of investments have been repatriated. Suppose I'm doing a disinvestment, then the sale proceeds need to be brought to India within 90 days. Form FC is filed in the current year for the disinvestment. Other terms and conditions, whenever I'm doing such sale or purchase, it needs to be internationally valued. Internationally means I'm not talking about from an international agency. I'm talking about valuation which is internationally accepted. It can be done by an Indian valuer, but it should be one which is in a method which is internationally accepted. Then Form APR, foreign entity 1 year in operation has been complied with. Whether the sale proceeds were repatriated to India within 90 days. Sale proceeds I'm talking about here. See, here you are finding last year 60,000 was invested, current year it is 0, which means I have sold these shares. There is a disinvestment. So in those cases, within 90 days, the money should have come to India. Here, suppose the transaction has happened on 15th of March. As on 31st March, this became 0. But the money was not received in India. You are conducting an audit in the month of August, right? The 90 days as on 31st March have not passed, but based on an events occurring after the balance sheet date, the 90 days have passed. So what will you do in such condition? According to me, in such condition, we should report that the money has not been received within the 90 days. Even if it will not have an impact on my financial statement directly, but definitely there will be a FEMA consequence on this. There can be an interest penalty, etc. And based on the rule of events occurring after balance sheet date, this needs to be reported. Other current assets, there's this export realization. So whether this money is outstanding for more than 9 months, the outstanding 9 months or 15 months, whether the outstanding, as the case may be, whether AD bank extension approval has been obtained, whether export dues have been received without netting off. As I told you, it should not be netted off. The entire amount should come back. Other income might include your dividends, your interest, import creditors have been written off. So the creditors cannot be written off without an RBI permission. Right? So in case I am writing off any creditor or I am writing off any debtor, I need to take a written permission from the RBI. When I'm talking about the dividend or interest, this amount should be received within India in 90 days. Okay. The export debtors, I've covered this, that it should not be written off without RBI or AD bank permission. And again, the write-offs which I'm talking about, let it be of the creditors or let it be of the debtors, there is also a limit prescribed that only 10% of the total exports, etc., can be written off. So even those limits needs to be checked for. I cannot cover every such limit, but if you find such write-off, please check what limit is applicable to them. The ODI FLA cross-check, whether dues receivable from foreign entity are repatriated to India within the prescribed time. Then the earnings and expenditure in foreign currency are currently reported in Form FLA. Yeah. So now what is important in this red marked is, generally, if I have not received an ODI or I have not done an I have not received an FDR or I have not done an ODI, this Form FLA, Form APR, etc. are not applicable. If I've only done an import or export of goods, Form FLA is not applicable. But even if I am creating that foreign liability or asset in terms of trade creditors, trade debtors, but if Form FLA gets applicable, wherein you have received any FDI or you have made an ODI, means Form FLA becomes applicable. And as soon as Form FLA becomes applicable, if you run through the form, you will find a category wherein even your earning and expenditure in foreign currency needs to be reported over there. So yes, if Form FLA is filed, the current account transactions also get attracted. Attracted means also needs to be reported. But otherwise, if Form FLA itself is not applicable, then your current account transactions don't need to be reported in Form FLA only for the current account thing. Okay. Now I told you all the compliances that were required everywhere. They have missed the compliance. Means I need to jot down, and what do I need to do is report. Now, if you see, no, this is only one slide wherein I've not written anything. I think almost 30-35 slides we covered till now, telling you what is allowed under FEMA, what is not allowed, what compliance was required to be done. But our major topic of today's session was also audit reporting, right? So in audit reporting, if I am not telling you anything, why this slide is there? Let me be clear. In all the slides, we checked what was required to be done. And if something was not done, it is a non-compliance, right? Like any other type of non-compliance within the Indian regulations also, keeping aside the FEMA thing, what do? You jot it down. You try to evaluate whether the non-compliance or the consequence is affecting the true and fair view of my financial. If it is affecting, I need to report. Reporting will be again different kinds. Suppose I am not able to verify whether the impact is there on the financials, I do a disclaimer. If I do find something in the financials which is not impacting the true and fair, but the reader of the financial statement needs to know about it, I put it in my emphasis on matter. And if I feel the true and fair is impacted, but the impact is not incorporated in the financials, then I do a adverse reporting. Same exactly happens over here. If I run through all of these, I jot down whatever non-compliances have taken place. Evaluate which category it will fall into. If the non-compliance is one wherein only disclaimers required, give a disclaimer. Only emphasis of matter is required, give an emphasis. Put all this in the notes to accounts, give an emphasis in your auditor's report and go ahead. And if you feel that an adverse report is required, give an adverse report. So I cannot, without the facts, tell you for what kind of non-compliance or which kind of compliance, what is the type of reporting you will need to do. And hence, this slide is the shortest, and I will also not be spending too much time because this is a complete professional judgment which you have to take. We've already completed the session. It's almost 12:18. I'll throw the session open for any kind of questions.
Thank you, ma'am, for the presentation and explaining topic in simplifying way. So now I request all the participants and delegates, if you have any question, you can unmute yourself and ask directly to the ma'am, or you can put your questions in the chat box also.
I feel either I have confused you all too much or clarified every doubt.
Yeah, thank you very much, Raji. Namaste. Are you able
Namaste,
to
sir.
hear?
Yes, sir. Yes, sir.
Hello.
It's pleasure meeting you again, sir. So you are audible.
Yeah, okay, okay. Namaste. It was quite good and quite a detailed presentation you have given. Easy, as you rightly say. So it requires a lot of compliances because uh, in the past, government of India has been controlling FEMA very well. Nowadays, they have relaxed a lot of things, but still there are a lot
So
of
now it's
compliances
only
there.
visible vision. I mean, you feel that they are not checking, but now everything has become AI based. So there is a lot of checking that is happening in background. There are several notices that are being received.
Yeah, that's correct. That is because that efficiency has increased quite a lot.
Right, sir.
All these authorities, all the regulatory body. That is good for India. That's why if you see our GST has been increasing, and every front we have been doing quite well. So that is good. Only my question is a general question, not very specific. If somebody has having a branch there, how the FERA plays there?
So say whenever there is a branch,
Suppose some
so whenever there is a branch out there, it is not specifically an FDI or ODI transaction. It is your regular that you have an office out there. So office relate, I mean, firstly, the compliance is relating to setting up the branch office over there. That is local. So whether those are complied with, the monies that are being coming in and going to the through the branch. So for that, it will be majorly for the rental that you are paying for that office, the employees that are sitting in that office. So most of the expenses or income attached to the branch will be current account type transactions. It will not be more of capital account transactions. It is just an arm that has been extended. You have not made an investment over there. So all your current
Okay.
account related transactions, all monitoring related to current account transactions will take place. The TDS and all those things.
In case there is no investment done from India,
Hmm.
only technical know-how you are providing. In that case, how it is done?
Yeah, so technical know-how if you're providing, you will just be raising invoices for them.
Mhm.
That's what I'm saying. The branch which is set up over there is like I've set up a company in Mumbai, Maharashtra, and I am opening one office, say in the Northeast, in Assam. I've opened one office in Tamil Nadu and opened one office in Jammu and Kashmir. So similarly, I've opened one office in, say, Dubai. I've just opened an office, which is a rental office, which I have taken. Or if I'm purchasing the office, which is generally not allowed, in certain cases it would be allowed. If I'm purchasing based on the regulations, then it will be a capital account transaction. But otherwise, whatever, if I'm hiring that place, I'll pay rental for it. I'll be paying salaries for the people out there in foreign currency, maybe certain insurance. And so all of those are current account transactions.
Okay. And what about the bilateral treaty between the countries? Because
So bilateral, so that's what the bilateral treaties also
taxation, they
generally take
bring
care
in.
of my income and expenditure. Again, related to my current account transactions. So whenever I am making certain payment outside India, I will need to evaluate firstly from the Indian income tax point of view, whether that transaction is taxable in India. Then if it is taxable in India as per IT, I will check whether it is taxable in India as per DTAA. That is the double taxation avoidance agreement, the bilateral agreements which you are talking about. If both of these tell that the transaction is taxable in India, I have to deduct that TDS and only the net amount will be remitted to them. And the TDS needs to be then paid to the government account.
Sir,
You need
please,
to
please unmute yourself. Ma'am, just hold on. There is some
no problem, no
network.
problem.
So thank you, Sundar sir. If anyone have any question, you can unmute yourself and ask to directly to the ma'am, or you can put your questions in the chat box.
Hello.
Hello.
Meera ma'am, the PPT which you have presented on the screen, can we get this PPT?
Yeah, I'll share it with the organizers. They'll share it with you.
Okay, ठीक है. Thank you.
My pleasure, dear.
So ma'am, there is no more questions. So can we move forward?
No problem. If any of you have questions later on also, you can jot down my details. Will I share my screen again? So here are my contact details. You can drop in your messages out there and I will revert as soon as I can. Okay?
Thank you, ma'am.
Yeah. Thank you. Thank you, everyone. Thank you, Dr. Kataria and Vaibhav sir, for giving me this opportunity again to help me share my experiences and my knowledge with all of you. It's really been a pleasure. Thank you very much.
So ICS is pleased to provide you all its research and development, integrated management system that is QMS, CMS, and OSHA's excellence in education management. ISO made easy in Gujarati, Marathi, Telugu, and Hindi. For reading any of the above books, please contact me, Sushma Kindalkar, on the given contact details. Feedback form, please register on www.sadgunsung.org and go in your login and give your valued feedback to us. So thank you, Meera ma'am. Thank you all the participants and delegates for being part of today's Sadgun Sun. So now it's time for the to officially close the session. Thank you, everyone. Have a nice day.